Well, welcome back to the Contrarian, everybody. It's my pleasure to have David Hunter on again. It's crazy for me to think about, but it's been about 5 years now that I've been chatting with David regarding his macroeconomic outlook. He's a chief market strategist at Contrarian Macro Advisors. He's very active on Twitter at Dave H. Contrarian. He puts out a quarterly letter by subscription. He's been, I would say, the most accurate macro strategist forecaster I've talked with in the last 5 years or so. Um, David, thanks so much for coming on today.
Yeah, hi Logan. Thanks for having me back.
Yeah, no worries. There's a lot I want to chat with you today about. Of course, I think it'd be helpful maybe to talk about your updated targets. And then I know about a week ago you had kind of alluded to you saw a kind of sharp pullback as likely. And of course, we saw that the end of last week, especially in silver, precious metals. And then the general stock market indices have kind of treaded water, maybe churned a little lower in the last month. But maybe, yeah, start off with some updated targets you have, if there's any changes, and kind of what you see going forward from here after this
Sure.
brief pullback we've had.
Sure. Yeah, I'll start with equities. I mean, I think the stock market is still my view has not changed. We're in a historic bull market that I think has a long ways to run here. Could come very quickly in the between now and summer, but it's a good distance away. I raised targets because I can't remember when we last talked, but I raised targets in my October letter for the equity indexes. I raised my S&P target to 9,500 from 8,700, which had been raised from 8,000 during that April sell-off, but when tariffs were announced. So I went from 8,000 to 8,700 and then to 9,500. That remains my target there. The NASDAQ I raised from 30,000 to 32,000 back in October. The Dow from 60 to 65,000, and the Russell from 3,400, 3,800. So if you do the math from where we're at now, I think it's like 40% for the S&P. I'm not sure the Nasdaq's probably a little more than that, maybe. And the Russell outperforms them all, I think. I'm not sure what the number is from here, but it's 45% or more. So I do think we're seeing, as we come into this year, rotation into small caps, into some of the non-tech areas, and I see that continuing. In the short term, you may see a little more weakness or a bit more weakness in tech in particular. They could drop, several percent more from here. But it doesn't mean that the tech story is over or that they're not going to, return to being one of the leaders. I think they will. I think in what I call the final move into the top, I think tech will continue to play, but I think small caps will outperform tech. I think we're seeing right now industrials are doing very well. They're not even really impacted by the sell-off we've seen of late. We're seeing some momentum start to build in basic industry, materials, copper, steel, some of those things. So I think you're seeing a cyclical resurgence here. But I also think when I look at things that from here, just about right here, I expect that financials are going to, financials could certainly, the market still, in my opinion, probably still got a couple of percent downside risk here. And in tech, maybe more than that. But we're not very far. If you think about an S&P that can go up 40% and a couple percent downside, those that are, because I get this on X all the time, well, are we still going to get that pullback you call for? I said, why are you wasting your time on trying to pinpoint the last 2 or 3% when you've got 40% ahead of you? It makes no sense. And yet people seem to think what their job is to get in at the very bottom, which nobody does. And when it gets there, they're going to be hearing from Wall Street telling them it's going a lot lower. Right now we're hearing people talk about 10 and 20% corrections from here. Um, I'm not worried about that. I don't think that's the story at all. I'm very bullish going forward. I just think we've got to get, you know, this little correction that's been underway, kind of finish it up. We've really been in a high level consolidation since late last October. And so you've been kind of in a sideways consolidation for, you know, the Dow and the S&P. The Russell's actually broken out. It's been tech that's kind of weighed things down and had a bigger correction. But frankly, it's you're finishing it up. You're not starting something big. So yeah, you could get the S&P down to 6,700 perhaps. Maybe a little lower if it wanted to. But it's really small when you look at what's ahead. And when I look through different groups, even even things that you wouldn't think would be all that interesting right now, things like home builders, look like they're lifting up here, and I think we're going to have a strong spring selling season in housing. I think so. I think they'll go on to new highs here, and a month ago they looked dead. So what that argues for me, what that tells me, along with a lot of other things, is that the 10-year, the bond market is getting ready for a big rally. So it's been in a trading range for, quite a while, and it, got down under 4% on the 10-year, down under 4% several months ago, and then backed right back up, and we're back in that trading range between basically 430 and 4%. And I think we're about to roll that over. And once we go through 4% this time, I don't think we're going back up. So I think you got, when you think about it, you got going into the spring, the potential for lower rates, a strong economy. Because again, when I look at industrials and look at the materials and things like that, it looks like everything we're seeing with ISM and PMI, it looks like the economy is picking up speed on the industrial side, which absolutely makes sense when you think about the build out that's going on in AI, the data centers and the need for power and the build out there. Um, and all the reshoring and the capital that's coming in. Of course, that is all skewed towards the industrial side. And then you've got the consumer, and the consumer is kind of hanging in there. Again, it's a have and have not type situation, or a K like economy where, those that have money in the stock market and have houses feel pretty wealthy. Those that are at the bottom, in the bottom half of the economy, are struggling to get by because costs are high and their income's not matching it. So it's a mixed economy out there, but I think what's going to drive this is going to be that cyclical resurgence, including AI, and the fact that rates are going down means you also bring housing back into the equation, and probably, retail will be fine. It doesn't look like retail's ready to roll over. Actually, um, I think the last 4 quarters, credits look better. So I think all of that speaks to, in my opinion, a very big final push to a high. And that might take 3 months, it might take 6 months, but it's, I think we're in that period. And again, I don't mean right from today, because you've got to finish up this sell off or this correction, and to hear a lot of market analysts out there and people that watch the markets. You're hearing, like I said, you're hearing talk of 10 and 20%, or the market's peaked, or those kind of things. That's music to my ears, as you know. As a contrarian, I think you're seeing the sentiment is pretty, the wall of worry has been rebuilt. Um, and yet we're not far off the highs. So it's been an amazingly resilient market because of that. Every little sell off, and all of a sudden out come all the bears saying, "Oh, here we go," or "We're done, we're going down," and that just provides the future fuel for the run up.
Yeah, it is kind of amazing to see how quickly sentiment can get negative again, even just with a 2 or 3% pullback, and kind of like what you mentioned with the Nasdaq and S&P remaining pretty close to their all-time highs. Still, it's been a rebuilding of the wall of worry, as you said, and it sounds like you're separating the major market indices. You see a little bit of a pullback still possible there. Whereas it seems like with gold and silver, that might have even happened last week, or I guess based on the last few days, it seems like the precious metals might be done with that. But I'm curious to hear your outlook for those as well.
Yeah, the metals have been amazing, and it's you know, as I say, people go, "Well, what was the reason for that big, 35% sell off in silver? What triggered that?" And I go, "Did you look at what happened before that sell off? It was straight up and straight down, basically."
Yeah.
And I saw it coming, so I did call a 30% correction basically in silver. So I wasn't surprised by it, but it does when you get a 30% hit. Think about that. I mean, that oftentimes that's your full bear market, right? And in
Yeah, it was
silver
in
we
one
did
day.
it. In silver we did it in 1 or 2 days.
Yeah.
So it's easy to say that's a parabolic blow off, and we've reversed it, and now we're going down, and that's what I think a lot of analysts out there are saying. I see it as, and I saw it before the sell off, and I see it after the sell off. I see it as, yeah, you had this run up, very unusual run up, but very fast run up from um, basically, basically $48 up to 122, but in the last month from 70 up to 122, and then you gave back almost all of the January run up in 2 days, and so I think this, the bottom on Monday, which was down under 75, probably is the low for this sell off and the low for the correction. Um, can you we got up over 90 today. Can you come back down and retest? I think you can. Some doesn't mean you'll go all the way back to 75, but you could come back um, and retest. Will we? I don't know. Maybe you can argue that intraday on Monday, I don't remember exactly where it went, below 75. Depending on what you look at, I guess, but somewhere 73, 4, 5 in there. And then it rallied and then came back and didn't go all the way back down. You could even argue that that was your retest, but I don't know. I mean, we'll have to see what the next couple of days bring. But I do think any retest is this week. I don't think it's something that's a month from now. Um, and so that means, you're down there. And frankly, so many people did not take advantage of what happened Monday and said, "Oh, this thing's going down. People are looking for 50, etc." And so I think there's a lot of people on the sidelines wishing for a pullback here, wishing for a retest or lower, that are going to be disappointed. So, and markets tend not to accommodate. So again, it's a little bit like the stock market. I wouldn't spend too much time worrying about whether 90 is going to turn into 80 or not, because I just raised my target. Again, I'll go back to kind of my October. I had a 75 target on silver. I raised it to I think 100, and then I raised it again. I'm losing track of my targets because I've been raising them so much, but
Yeah.
I raised it again to 125, and it got up to 122 in this most recent spike. Um, I took a look at it this week, and I said, over the weekend and this week, and I raised my target from 125 to 180. And I feel pretty good about that. There are people that think I'm still too low, but there's a lot of people think I'm crazy at 182. So at 180. So that's probably a good number. Um, but I mean, that's a huge. Think about it. Silver was $30 not
Yeah.
that long ago, and if it goes to 80, it's a six-fold run in a year's time or less. Um, so, but that's where I'm at on silver, and I think it is as you know, I'm looking for a global bust later. So all these things, stock market and the metals markets, we're talking about cycle highs. We're talking, I call them my pre-bust targets, but they're basically my cycle highs. Is it possible I will have to raise it again? It's always possible, but I think 180 is a pretty big, run from here. Um, Gold, similar story, but not obviously as elevated. I raised my gold target from 3,400 to 4,000 sometime last year. Raised it again in January to 50. I think I had raised to 5,000 and again to 5,500 in January. Um, and I just raised that up to 6,800 um, for same time frame as silver here. So I mean, again, that's a big run for gold, which not that long ago was 3,000 or below, and now we're talking about almost 7,000. So um, I think we're in the sweet spot for these metals. As I say, it's not unlike the stock market, which I think the peaks there this cycle will stand for decades. Silver and gold will have another huge run post bust. So once we go through a global bust, come out the other side, maybe in 2027, later part of 2027, from there to maybe 2032 or three, gold could go to 20,000 and silver 500. Those have been as you know, those have been long term, long held targets for me. I've had them for probably 5 years. Um, I'm thinking now, after we're seeing what we're seeing now, the odds are that those, at the time, they seemed absurd. I had a lot of people thinking that's crazy. Um, I'm beginning to think those are way too conservative,
Yeah.
particularly for silver. So,
Yeah. Oh,
but
yeah.
they won't seem as absurd or as conservative um, if we go through the bus. Because silver, let's say I'm right about 180, or just to round it off, let's say 200. In the bust, you could get silver back to $50, because it's so cyclical. So you know, I'm not about to raise my long term targets till we get through the bust and see what we're doing. But I'm just saying, if it can get anywhere near 200 this cycle, I'm not sure 500 is anywhere near close to where it's going. If we get the kind of cycle I think will follow the bust.
Exactly. So it sounds like, I mean, you're very bullish, of course, in the short term, pre-bust, and then post-bust, it's a little harder to tell, of course, but sounds like you see like a commodity super cycle and kind of inflationary driven cycle after that. But yeah, kind of pre-bust, maybe we could talk a little bit about Fed policy coming up because, of course, in the last week, Trump just mentioned that he'll probably appoint Kevin Warsh to replace Jerome Powell coming up. And so that could be another, I guess, bullish factor going forward as well, is perhaps investors beginning to see maybe the Fed will be a little more accommodative or, however you want to put it, dovish. Um, but it is just like one vote out of 12 total people. So, yeah, how much do you think that will factor in at all to the melt up kind of story?
Yeah, it's funny. I have a different take than what you hear a lot out there on the street. For whatever reason, people, and I think some of it has to do with Trump. Is the TDS or whatever you want to, the negative view of Trump. So no matter what, the media spins everything negative when it comes out. So Kevin Warsh, who I thought was a great pick. I mean, he's kind of the right guy for to head to be chairman of the Fed. He's got the experience. He's been on the Fed before. I like him because he basically has a monetarist background. Um, but when he was chosen, and of course, I think any of the ones they had in this final list would have been okay. I wasn't worried about that pick. I didn't think it was consequential, like everybody was sitting on it waiting for it. But I wasn't, and but I think he was my first choice, and it was a good pick. But the street narrative out there is that he is a hawk, and that what's Trump doing? He's going to have same problems he had with Powell. He's going to have with Warsh, or
Yeah.
he doesn't know what he's doing. Warsh is going to pull a fast one here and get in there, and then Trump's not going to be happy. No, that's not it at all. Warsh is a monetarist, and rightfully so. Looks at the fact that our balance sheet has expanded from 800. The Fed's balance sheet has expanded from 875 billion in October of 2008 to where it got up to 9 trillion in post right in the pandemic. Um, and so now it's been brought back to 6.5 trillion. Powell's done that, and did it without crashing the economy, and without rates going through the roof. So I give Powell pretty good kudos for that. But Warsh, rightfully so, says the balance sheets, we're inflating assets and everything else with all the money printing we've done over the years. Not recently, obviously. If it shrunk from 9 to 6.5, that's not new money. We're not pumping new money in there, but in the pandemic we put 5 trillion in. So he wants to bring it back down. And so the street, I get what they're worried about. They think that that's tightening. That's going to be a problem. That's going to drive rates up. The thing is, Warsh is not putting a time frame on it and saying I want to do that immediately. So he may do it gradually. He may do a little bit of it. My take is basically I'm not even worried about that because the bust is going to dictate what the Fed does. I don't care whether it was Warsh or Powell or anybody else. When we get into a free falling financial system, that balance sheet's going to be expanded greatly. Now, none of our policymakers have that on their radar, none of them. And so they're not sitting there thinking about that and saying, what do we have to do? They're looking at it and assuming will it be in a stable economy, period, and that we can gradually bring, or at least Warshes, that we can gradually bring the balance sheet down. So I'm not really worried about what he thinks. And the other part that does fit with Trump and why I think he chose him, number one, he's looking to reform the Fed and get them away from this focus on quarter to quarter economy or month to month data, and trying to fine tune the economy on every data point. He wants to get it back to what it years ago. It wasn't like that. It was much more bigger picture, kind of how I approach the economy, how I approach my forecasting. And so I think that's good. He's also, I think, and in fact, after he was named, he did some interviews, and you heard him say this exactly. He goes, I think the Fed's too caught up in this idea that if you get growth, it's going to push inflation up. And he said, I think, given what we're seeing in productivity, given AI and deregulation, et cetera, you can have growth without inflation, and that the Fed's been doing a disservice in terms of keeping rates too high because they're wrongly worried about inflation because of the economy. So every time the economy gets some growth, they stop, they hike rates or they stop decreasing rates. And he said, we have, as Trump has said, we have the highest rates or some of the highest rates in the world. And yet we're the most productive economy, and our inflation's some of the lowest. And it's like, what are we doing? So that's where I think Trump and Warsh saw eye to eye. I think Trump rightfully saw Warsh as the right man for the job, not so much focused on what's he going to do next month or in the meetings, but really understanding that this is a guy that knows monetary economics, knows monetary policy, and knows the Fed and wants to reform it. And so I view it as a very big positive, not a negative.
Yeah, and I know the market kind of reacted to it that one day last week when Trump mentioned it. I think it sold off that day, but I'm curious if you think like hypothetically, if the Fed were to be, I guess, more proactive as opposed to reactive, and they, started lowering rates, and maybe the bond market kind of lowers rates as well in the coming months, which I think you see as likely. Do you think in that kind of a scenario, if there's steady growth in the U.S. economy as well at that same time, is it possible that the bust is kind of avoided or pushed out further, or isn't as severe as what you see? Or I know you said that like the seeds have been sown for the bust, but is it possible that maybe there's a lot more AI capex spending or other kind of stimulative kind of spending that comes into play that is able to kind of lessen the bust that ends up happening?
Yeah, let me put it this way: if you look today and you see the acceleration in capital spending, and you look at the ISM and all those things, it's crazy to be thinking about a bust. I mean, right now it looks like the economy's come through a period of under Biden where it was relatively flattish or not doing as well, and it picked up steam last year and is picking up more steam this year. It's hard, and the stock market's at all time highs. Inflation's basically contained, and I think is going lower. Um, it's hard to think that a global bust is anywhere near in the picture. In fact, why would somebody be saying global bust, right? It's, if I wasn't, and I'm not um, trying to make myself out to be the guy that everybody listens to, but let's face it, global bust is my term that I brought out 5 years ago or 6 or 7 years ago, whenever. Um, and yeah, it's probably then. And it's kind of out there now. Lots of people talk about bust now, right? And they never used that term when I was starting out to talk about it. So it's on a lot of people's minds because we did look like we were going to see that during the pandemic. It looked like it, and then after the pandemic, some of the time when things were not looking great. But really, right now, it's hard to talk about a bust and say that it's imminent. There's nothing there right now that's imminent. I'm not giving up, or I'm not um, changing my forecast. I don't know whether it's going to happen. I still say it very well could be second half of this year, probably latter, last 4 months of the year. But I don't know, because a bust is something that number one, it's global. So it doesn't, it's not just to focus on the U.S. It's what can happen around the world. Um, and the real reason for a bust is the leverage in the system, so that once things do roll over, it's going to roll over fast and get pretty nasty in the financial system. Um, there's problems in China. We know that. There's problems in Japan. We know that. In terms of their rates are breaking out, inflation's starting to push up, and they don't have any room for error there. Um, Canada's in trouble. Australia, I don't, I'm not sure. They just hiked rates. I think their policies are backwards. Um, Europe's Europe's got all kinds of problems under the surface. You can look and say, hey, their stock markets are doing well, and Lagarde's already done their easing, so they're in good shape here. But under the surface, an overall economy that's weighed down by a lot of socialist policies, and energy is an issue, et cetera. So there's plenty of fragility in the system. There's leverage like we've never seen before in the system. So we can go from looking pretty good to things getting really out of hand on the downside in a hurry. We're not there now. There's nothing on the horizon right now to say, to be able to predict when it's going to hit, meaning in the next several months. Um, but I'd remind you that in 2008, I remember this because in September 2008, I was saying hard landing. And most of the economists out there, almost every single Wall Street economist was saying soft landing, no recession in sight. And that was September of 2008. Lehman Brothers happened in early October, and the rest is history. So we went into we were less than a month from the biggest financial crisis in history and yet, people were pretty much sanguine and thought things were okay. So it can happen fast. I'm not saying that to say that's where we're at now. I'm saying that by summer, that could be where we're at, where things look okay, but starting to fray, and there's some real problems that can pick up speed in a hurry. So I'm not abandoning a 2026 global bust, but I certainly am not hanging my hat on it either because, people say, well, we got the elections and, the midterm election in November, your forecast is going to screw that up. If it happens before then, yes. Could it be that it doesn't happen until after that? It's a possibility, but I'm not pushing my forecast out. I'm just saying it's too early to know. It's but I do think that ultimately we'll have this blow off in the market. We'll still be fragile. We'll still be highly leveraged. In fact, more leveraged than ever. And then I think as the tide goes out, you're going to see the things underneath the surface that really can cause problems. So I caution people now: don't get bearish early because you're going to miss one of the biggest runs in history. We could go up 40% in 3 or 4 or 5 months, but and some stocks could double in that time, and in the miners' case, could triple in that time. So it's not, too many people hear the bad story and they get nervous and they jump to buying bonds today. If you want to be a long-term investor and not worry about the returns, being early is better than being late. But if you do that, you're sitting there making a little bit of money when other people are making, or you could be making a lot of money. So it's I think all I know is that it looks like this from here through the mid-year, it looks like we're going to have a lot of things working very well for the markets.
Yeah, so that's interesting because it sounds like in your mind we could be, 6 months, maybe 9 months out from a historic economic bust, but at the same time, before then, it's almost like you see a very parabolic, melt up that we talked about, of course. And it sounds like almost all assets would perform well during that environment, even bonds, I mean, with rates coming down, and maybe real estate as well, if rates come down. So. Yeah, I mean, it would kind of lead to a scenario where, of course, at that point, you'd probably have sentiment looking entirely different than what it is now, like people being very optimistic, um, being all in. And then in that kind of a environment, yeah, I could see a reason for there being an economic bust as a result of that, just with the fragility that that creates.
Yeah,
I'm wondering,
just
yeah.
in response to that, the easier part of a forecast for me is the market forecast because the market is so driven by sentiment. So that's what I kept trying to say because I've been, as you know, been talking about this melt up for a long time, and that we would ultimately have a top. And and people would say, well, what will cause you to change your bullish view when are you going to know to get out? And I always pointed to sentiment, right? I said when everybody's all in, I'm out. When I hear everybody, and it was hard for people, I think, to envision that you're going to have a period. It's not going to be easy to be bearish because, as you say, there's going to be several things all at once looking good. Lower rates, strong economy, Trump's policies seemingly working well. Maybe we'll have the end of Ukraine, Russia as a war. Maybe the Middle East will be resolved to a good extent. There could be a lot of good news things, and it's very hard to envision that there's any reason to sell when all ships are rising, and it just so. But that's probably when it's going to be. And I don't mean the minute you sense that everybody's agreeing with the bullish view, there's time to get out. It's a process, but there will come a time when I'm gonna, as much as I had to fight when I was bullish, had to fight all the critics or hear all the critics when I was bullish in 2022, for example, or spring of 20. As much as I had to fight then and took a lot of criticism then, I'll hear that same criticism on the other side if I'm bearish when everybody's bullish. So that's I'm pretty confident in saying we'll see a top in the stock market this year and probably in the next 3 to 6 months. It's a little harder to know exactly when the economy rolls over and you have a bust, because there it can be other things. It can get stretched out. The rollover, the process of topping can take time in the market. So there's not people. It's not. Let's put it this way: a bust is not going to be um, coincident with the top in the stock market. Stock market will peak ahead of that by probably several months. But whether it's 3 months or 6 or 8 months, but top of the stock market probably happens before you really even see the signs of a bust.
Okay. And of course, you have it, or you see like a deflationary bust as being likely, where we actually have asset price deflation, deflation in commodities as well. And I was curious to get your thoughts on inflation. And do you think inflation is miscalculated right now? Because there's a lot of different metrics available out there. There's, of course, the CPI, PPI, like the official BLS numbers, and then there's alternate ways that inflation is measured currently. Is there a particular one that you think is most accurate or reflective of what everyday consumers experience?
Yeah, not really. Part of the problem we have, and again, the media makes this hard, is a lot of consumers misunderstand what inflation is versus what high prices are. So, we've had high prices as a result of policies for a long time, and they got driven up during the pandemic. Inflation can be zero, and it doesn't mean you give them back those high prices, right? So I think a lot of the people unhappy with Trump, and the media is obviously using it to try to slam him or hurt him, is the focus on high prices. They call it inflation, but what they're really focused on is high prices. I mean, frankly, look at eggs. Eggs have had very big deflation. I bought eggs last week and they were $1.50 during the shortage. I think eggs were $7 or higher. So eggs have had a big decline. Not that that's as one input, but I think part of the problem is misunderstanding what inflation is. I don't have one particular indicator I look at. Obviously look at CPI, PPI, PCE, but then you've got trueflation out there, obviously on the low end. What is interesting to me, and again, I think some of it's the bias against Trump, is and Fed fighting the last war to some extent, is they openly admit, and they know and have known for a long time, that the indexes are flawed because what they use to impute inflation on housing, through a rental instrument rental calculation is very lagged, is very delayed, so that when prices are coming down or you're starting to see a rollover in real estate, it doesn't show up for a long time. And so they openly admit that inflation's artificially held high by that flaw. Um, and then it's also some of the things they use as input, like um, you know more portfolio management fees, investment fees that are calculated on the value of the portfolio. That causes fees to jump and look like it's inflation, and it's really not. It's not something that everyday person is having to deal with. So, people, it's good news that people's portfolios are going up. These are mostly institutional fees, so it tends to be more on the wealthy anyway. But those fees are going up simply because they're a percentage of the value of the portfolio, and the portfolio is going up in value. So because of the stock market. So you got things like that are really not capturing inflation as it is today. So it's hard, if you want to get into an argument with the everyday guy and try to tell him that inflation's low, they're going to take issue with you because they're not seeing it in their, they go to the store and they go, my bill's not lower, but that's not inflation. That's because they've been, they got pushed up and now they're staying up. So people when you talk about lower inflation, people think deflation. And that's not what we're talking about. We're talking about disinflation. But that being said, I do think trueflation shouldn't be ignored. And if you use that number, it's under 1%, which means the Fed is thinking that you've got 2.7 or 3% inflation, so they don't want to ease. And in fact, if inflation is under 2%, they should be saying, yeah, we've done our job. Um, you know, the jobs picture is starting to slow. And so we should be easier. So, all these people that want to make it out like Trump was wrong and had no reason to be upset with Powell. I mean, I've been a defender of Powell for a lot of reasons, in terms of looking at what the Fed has done. But I do admit that he's been reluctant. And it's not just him; it's the whole committee. Um, has been kind of fighting the last war of being slow to recognize that we really have already done our job, or they have already done their job. Um, so, so I think ultimately, yeah, if you get a new Fed chair in there, he's probably going to be able to make the argument that inflation is, you know, at our 2% target or below. And in Warsh's case, he'll be saying, just because the economy is doing okay, actually doing pretty well, is no reason that we have to keep policy restrictive so rates can come down some more.
Yeah, that would be an interesting dynamic to see if Warsh or other leadership kind of can maybe see that a little more clearly, that they don't have to fight the last war of inflation anymore. Because of course they are worried about like the mistake they made in 2021 of staying easy way too long, um, and then the massive inflation that happened in 2022. So they're kind of still concerned about that. Um, it sounds like, though, in the bust, switching into that, it seems like you've said that there'd only be like two asset classes that would likely hold up well, and that would be the dollar and US Treasuries. Um, I know there's some people out there maybe thinking like, oh, maybe something like real estate, maybe something like gold could also hold up, but it sounds like in an economic bust of the type, the magnitude that you're thinking, I could see why something only in the category of US treasuries and the dollar would hold up. And in fact, you think like stock market could have up to like 80% sell off. Of course, silver could be hit really hard, gold as well. Um, Curious to get your thoughts on that in terms of like why you see US Treasuries, the dollar being the only safe havens.
Yeah. So, if you're an institutional portfolio manager, which I was at one time, sometimes your bogey is outperforming, not absolute performance, right? So if the market goes down 70 or 80%, and your holdings go down 40%, you're looking pretty good, but you've just lost a lot of money for your clients, right? So,
Yep.
but in most investors, most people, retail, small investor, etc., and frankly, all investors, I think absolute is very important to them. And so I think there's going to be very few assets that hold their value and in Treasury's case, maybe go up. But so gold's going to go down a lot less than the market, I think. Whether that's 30% or 35 or 40%. But if the market goes down 70 or 80, it will outperform. But that's still a big hit. Silver is more cyclical, so that can go down almost like the market, I think. Copper is another metal that's doing very well right now, but is very cyclical, and that could go down a lot. You can find sectors in the stock market that will go down less. Certainly utilities will hold up more than other things because they have the dividend, they're interest rate sensitive, but they're also now kind of being bought on the basis of their growth, for the fact that we're building out our electric grid. So they're going to get hit, whether they get hit 30% instead of 80 or 40% instead of 80, who knows? But and staples, historically, consumer staples are defensive, so they'll go down maybe less than 80. But if the market's going down 80, it means a lot of things are going down a lot, right? So it's hard for me to look at sectors and say, yeah, you can own this for defensive reasons, because you're not going to be happy with what that defensive number is. Um, you can certainly be in savings accounts in the bank as long as you stay within the $250,000 FDIC insurance threshold, and that's per institution. You can spread it around to many institutions if you have that kind of money you have to protect. And I'm very confident that even in a global bust, that the government would fund the FDIC to whatever level they have to, because of the printing press. The Fed will be printing money like crazy. If you've got a deflationary global bust, that means the Fed doesn't have to worry about inflation. That means their only concern when they finally figure it out will be protecting the system. It'll be a free falling financial system that they have to figure out a way to stabilize and turn back up. That will take a lot of money. That's the only thing out there that can move fast enough. Just think of the pandemic and what was going on in the first quarter of or second quarter of 2020. When the bond market was falling apart. Small businesses were closing, and had nothing. We closed down the economy, and so they printed all kinds of money, came up with all kinds of programs to support the capital markets. And that's what you'll see in a bust is when things are free falling, they can get creative and figure out ways to kind of stop things. But it takes time. The free fall happens very quickly. The deliberations of what to do and figuring out what to do may seem fast in a slow time when things are just kind of steady, but in free fall, days are slow. So if your day's late, you're late. Um, so it's cash is the one thing, or money is the one thing that can be pushed out quickly. So the Fed can do QE very fast, and that's the one thing that can be enacted quickly and to stabilize things. So you will see, as I've predicted, at least that's my prediction, is that you will see $20 trillion or something of that kind of number that will be necessary to kind of stabilize things and get things going the other way. And there's leads and lags, so they're going to overshoot. So, it doesn't mean they needed 20, but they'll be doing 20 because they won't have seen the progress yet, is my guess. And you'll see like similar type numbers or similar type proportionally coming out of all central banks in the world because it's a global bust. So, but in that kind of environment, yeah, stock market or stocks don't work well. Um, Below government guaranteed bonds, there's gradations of it. Junk bonds don't work well. Um, Low investment grade bonds don't probably do so well. Maybe high investment grade, double A, triple A, hold up better, but they're still probably down 20%. Um, and you've got um, private credit is going to get hammered. Um, you're going to have problems in pension funds. You're going to have all kinds of issues out there if this comes to pass. And so, yeah, I think it's basically bank accounts within the insured threshold. Um, um, Treasuries of all maturities, treasury bills will hold up. Treasury bonds will actually appreciate because of the rates will be coming down. And, not much else.
Yeah, yeah, I can see why you would see that as likely then. I guess just also looking at past, the 2008 or even in 2020, what happened there. And it sounds like you're not really concerned about something like a bail-in having to happen in the US, because like you mentioned, with the dollar still being the world's reserve currency and the printing, the ability for the Fed and the Treasury to monetize debt and, stimulate the economy that way, that would seem to be a more preferable choice for them as opposed to likely causing a lot of people to be very angry if a bail-in were to happen.
Yeah,
Um,
plus it's not just they don't want to make people angry. I think we have a tradition here of, and it doesn't help you much if you're trying to revive an economy, um, you know, destroying people's wealth and destroying people's life savings is not exactly going to give you much to work with. So I mean, there's a reason why you don't want to do bail-ins. Um, there's a history of bail-ins, obviously, over in Europe, so I can't say that you won't see it there. But I think around the world, the inclination is going to be if we're printing money like there's no tomorrow, that money is going to be put to use in all kinds of ways that are protective of the individual. It's very counterproductive to save the system but destroy the consumer while you're at it, right? I mean, if they're going to be
yeah.
hurt very badly anyway. But if they were smart enough to put their money in so-called safe places, you don't want to destroy that. So we saw in 2008, for example, that they backstopped money market funds even though they weren't insured. They had the don't break a buck policy, so the government backstopped the money market funds and then took that backstop away after we recovered. I think they would reinstate that, is my guess. You can't know that. The difference between treasuries and the treasuries and the FDIC insured is, the treasuries are explicitly guaranteed and the FDIC too, whereas the other is just a premise that they'll do that again. They don't have to. But I think the odds are that you would see all kinds of programs to make sure that people's assets weren't taken down with the system.
I'm curious to hear, because of course, with the Fed going into that kind of a quantitative easing policy, they would be buying massive amounts of treasury bonds and US treasuries, broadly speaking. Um, I'm curious if you think it's possible at all that they go into buying equities simply because of, you look at something like passive investing, how, you know, broadly speaking, most investors own kind of the same basket of stocks, the largest US stocks. And if people suddenly sell, that creates, like you've mentioned, the possibility of like 80% drawdown. And if that happens, you'd have, people's net worth massively being cut, which would hurt the economy quite a bit. And um, I don't know. Maybe that's going too far. Maybe the Fed would never do that, buying equities, but I don't know. What are your thoughts on that?
Well, in 2008-9, I think that was the time that we heard all about the plunge protection team, right? The rumor was that the Fed had a plunge protection team, or the government did. I can't remember exactly. And the idea was that they were propping up the stock market. Typically, they prop up the stock market through through printing money, and then it goes into the system and works its way through to buying stocks. So I'm not necessarily thinking that's likely. Um, but anything's possible. Like, you're going to see programs we never saw before, I'm sure. Um, I still think what you're going to find is that they'll do things like that at the margin, maybe, because there's always Trump certainly is a problem solver and thinks, tries to figure out ways. I don't always agree with him, like this, you know, trying to figure out how to make housing affordable. Housing will become affordable in that downturn. Don't worry. um,
Yeah.
or the price will come down anyway. And putting a cap on credit card rates, I don't totally disagree with the need for reform there. I don't agree with a lot of the analysts out there that think you have to have 30% plus usurious rates and encourage low income people that shouldn't have a credit card to do that, and you're protected because a certain number of those get written off, but you've charged enough interest. I don't agree with that as a model. So I wouldn't disagree with putting some kind of cap on it, because I think we used to have a cap, down 18% or 20, something like that. I wouldn't be opposed to that. I think 10%, you're getting into a place where you're socializing banking. You don't want to do that, or price control type thing. So I don't agree with that, or the housing. All for trying to figure out ways to build, boost supply of housing, but not this other stuff where you're trying to figure out a way to um, make it affordable because you put in policies. But back to the other, yeah, I just think that most of the situation is going to be solved. Or I don't know if the word solved, but will be handled through QE. It'll be they'll be doing. Just look at the pandemic as your model. Some of it 2008-9 too. We bailed out the banks. The banks would have failed if not in 2008-9. They'll do that again, I think. They'll do things to backstop, I think, brokerage industry if brokers get into real trouble. I don't think they're going to let widespread customer losses take place in terms of because the broker went under, meaning that people suffer losses because their portfolios are in stocks that go down or in assets that go down. But I don't think they have to worry about the brokers going down and they lose their assets. You've got, number one, you've got SIPC, insurance, et cetera. But I think the government, even though they're not expressively part of that, I think they would probably come up with a program to support SIPC or whatever if it got to that point where that those reserves were exceeded and they needed help. So people hear bust and they think 1930s depression. I think this will be, if it happens, it will be more like 2008-9 except bigger, but fast, and with resolutions on the inside. As I keep saying, the Austrians out there have a view of the Great Reset, and this is the time down. And Peter Schiff is probably one of the biggest proponents of this idea that we're going down now, and we get this Great Reset. And I go, what separates me from that view is I think there's one more cycle, because in low inflation or deflation, you have the printing press and you can use it infinitely, because there's a lag to when that money will become inflationary. So we have one more cycle where the printing press will be paramount and will bail us out, kick the can down the road one more time. And then the problem is, next time you don't have low inflation or deflation. Next time you have hyperinflation. So if we get to the early 2030s, and you've got 20% plus interest rates or 20% plus inflation, number one, those interest rates are, interest rates tend to follow inflation. So in 1982 or 1981, the 30-year was 15%. This time, and inflation was, up around 20%. T-bills were 21%. I think this, next cycle after the bust, because of all that money printed during the bust, you're going to have inflation exceed that. You're going to have interest rates exceed that period. So you could be looking at a scenario where you have 25% inflation and, T-bills at 25, 23, 4, 5%, and the long bond at 18 to 20%. Given the kind of debt we have, and it's going to only expand during the bust, right? It could double. You're going to have a situation where you have maybe, let's say, twice the debt we have today, or 1.5 times the debt we have today, and have to service it at high double digits. It doesn't work. We can't service it at 5%, right? So
Yeah.
and again, right now we've got short rates down so that you can keep rolling T-bills, and they're not 4 or 5%. They're down in 2 or 3%. At the time when you have hyperinflation, you're going to have an inverted yield curve. So the short end is higher than the long end. So you're going to have 20% plus short end, and you're going to have close to 20 in the long end. There's no way you finance that, and there's no way you fund the rest of the government if you have that, right? So then, first of all, and long before that point, you've lost the printing press because you can't keep printing money into inflation. It's like putting gasoline in having a fire hose, pouring out gasoline on a forest fire. It just ignites the inflation even higher. So the printing press gets pulled away sometime late this decade, probably, 28, 29, I don't know. And then from there, that's one of the things that's propped up standard of living, is we just keep printing our way out of this. At that point, that starts failing. People are going to have a hard time keeping up with inflation. There'll be cost of living things in place, et cetera. But you fall behind in that period, most people. And then you get to the point where the government, stole from Peter to pay Paul in every way they could to keep the thing going. And now they don't have anywhere to go for it. And the reality comes in that they are insolvent, that they can't. There'll be moratoriums, debt moratoriums, there'll be things to stretch out as long as they can. But I believe by the time we get to 2033, 34, 35, somewhere in there, the game's over and the Ponzi scheme just collapses onto itself. And again, I'm describing the U.S., but this is the world. I mean, we've all done this. So I mean, I think that's whether the bus starts this year or doesn't start this year, I think that's where we're headed. Now, could I be wrong? Sure. If somehow Trump policies really do get us rolling here, and we really do, we're able to pay down debt and avoid a very deep recession, and what comes in terms of unwinding the leverage, then maybe we do have a less than a bust in terms of a down cycle. We have to have a down cycle somewhere. We're at extremes here, so there'll be a down cycle. Whether it's going to be as big as I say it's going to be, time will tell. Um, I think the odds are it is going to be a bust, but I can't. I can forecast it, but that doesn't mean it's right.
Yeah, I think that's cool to keep in mind, of course, what you see as likely versus other possible scenarios. And um, I know we've talked about it, of course, in the past, and of course, it's not a very contrarian statement just to like get your financial house in order and just be responsible, generally speaking. But I know you've mentioned that as kind of just a common sense practice that anybody listening can put into play of, of course, not having, you know, high interest debt to your name, paying it off as quickly as you can if you do. Um, just generally speaking, like getting your house in order. I wonder if there's any specific things you would add to that or just recommendations for people generally speaking as we go forward.
Yeah, I first of all, basically it's control what you can control. You know, we can all talk about a global bust coming, but we can't control the global bust. We can't do anything about that. We can control what we can control, and for example, if I'm and again, it's hard. One of the reasons I've been on X for over a decade is to hopefully they don't get any economic education in school. Most people come out of both high school and college with very little understanding of the economy, and we've been a consumer oriented economy for a long time. So it's and they're teased with all kinds of credit, and so it's you know, and young people want what they want, so it becomes buy today and worry about paying for it tomorrow, right? If at all, and you get yourself into a situation where you have a lot of debt, and you know, in houses it's worked out because houses appreciated, and you had a mortgage, but you were over time the value of your house went up, and you're paying the mortgage down a little at a time. So that equation worked only because primarily because we had such a great run in housing prices over the last, 40 years. Um, but, that's not always going to be the case. I think the real estate peak this cycle is going to stand for decades. So even housing, don't, don't, even if you can afford it, I would argue don't get yourself so far in debt because you want that bigger house or you want what you want. Um, but certainly autos is a depreciating asset, and I'm amazed at what people are doing in terms of you know buying $50,000 cars with 7-year car loans, or um, or $75,000 cars. Um, I would tell people again, people have to do what they feel comfortable with, but if you can be satisfied with something less and have less debt, just know that what things look like today is not what things will look like 5 years from now. So um, I would just say you know um, live within your means to the greatest extent possible. If you're outside your means already, work on getting your debt down, because the people that are going to have the best chance of dealing with what's coming, I think, in the 2030s, are going to be those that are debt free, that got their financial house in order. And part of that is in the marketplace, the stock market. If you just buy into the buy and hold strategy that's worked so well for the last 40 years, from the mid 1980s when the mantra really came on, that it's time in the market, not timing the market. If you listen to that for the last 40 years, lots of people are millionaires because of that. They just kept in their 401ks and in their investments, just kept putting money into a mutual fund, and they rode it up and down. They just held it. And so we've had some bear markets, and they got nervous during those bear markets, but it always went on to new highs. And look at us today; we're at all-time highs, and a lot of people have made. Um, I know the Dow, so I can quote the Dow. I can't quote the S&P because I can't remember what the number was back in 1982. But at the bottom in 1982, I was running pension money, and I said to buy in August of 1982. The Dow was, I think, 780, $780, and it's now 50,000. So that's what's happened in the last 40 years. Um, so we're not going to see that repeat. In fact, we'll see, much of that begin to reverse. So my point is the mantra that has worked so well for the last 4 decades, from your financial advisors and pretty much anybody in the financial industry, of don't try to time the market. Most people aren't good at that. You're far better off understanding the compounding nature of money and interest, and just keep putting money in dollar cost average or what have you, put it into a fund, and it will grow and grow and grow. It'll have some ups and downs, but the trend will be up. I'm saying here that is not going to be the strategy that will be successful going forward. If you continue that strategy after, let's say the next 6 months, um, you're going to be, if I'm right that you're going to have a bear market of a magnitude of 70 or 80%, you're going to be spending the rest of your time trying to climb back out of that hole. So if, let's say, you have a portfolio that that your money manager um, does better than the market, so the market goes down 70% and your portfolio only goes down 50, it's still going to take you a while to get that 50% back, because to get back to even, you have to double your money, right?
Yeah.
Um, if you go down 70, if you're in an S&P and it goes down 70 or 80%, you're going to have to, it's going to be even harder. So if you can protect, that's one step in that whole process of getting your house in order, is if you can, and you don't have to be perfect, but if you can get out before the bear market, or get out early before the bear market really picks up speed, and just sit out the bear market, you're a huge step ahead. And then on the other side, the very important thing is that coming out of that bear market, coming out of the bust, it will be different leadership. So it certainly won't be buying indexes that will be the most successful, although everything will rise coming out of the bottom. When you print as much money as I'm talking about printing, and you go down 70 or 80%, you could see the S&P triple out of that bottom, or even more out of that bottom. But then it's going to level off and struggle having to face inflation the rest of the cycle. So the leadership of the next cycle, rather than being growth stocks and tech stocks, um, and things that benefited from interest rates going from high double digit to low, um, it's going to be things that benefit from inflation, which is, first and foremost, commodities and precious metals. It'll be energy, which is a commodity. It will be industrial companies that are, feeding into what's driving the inflation. So they're, a company like Caterpillar will be sort of, a lot of their business comes from the mining industry, right? So they'll have plenty of business, and so their margins will expand and be able to keep ahead of inflation. But it won't be consumer stocks. The consumer will have been hit hard, because the majority of people aren't going to be doing what I'm talking about right now. So they're going to get hit hard. Their wealth is going to go down. They're going to lose jobs in the bust, and they'll be digging out for several years after the bust. Right? Look at any of our recessions. It doesn't. The stock market may snap back quickly, but the economy doesn't come back that quickly. It may not feel like you're out of a recession the first year out. So they're going to be, um, you know, the consumer is going to be constrained. Um, Growth stocks initially you'll do okay because you're down near zero interest rates, and the first year out is they might go up a little bit, but they're not going to go roaring away. But as rates go up with inflation through the cycle, that really hits growth stocks because they depend on low interest. They depend on rates coming down, not going up. Um, and same thing with utilities, same thing with consumer staples. So, the things that will work in the next cycle will be primarily the things that can have pricing power that can keep them ahead of inflation, keep their earnings ahead of inflation. And the first on that list is really commodities. And I would tell you, as bearish as I've been on energy, on the other side of the bust, energy will be one of the big winners. I'm calling for $500 oil by early 2030s, and that will be coming from, I think, $30 or below in the bust. So you could see where that will be a big wind at your back type trade. So that's a part of getting your financial house in order, is to understand the market enough. You don't have to know it like I know it, but to understand it enough to kind of protect your capital when you need to protect it, and then get into some better areas on the other side of the bust. And then after that, it's really um, you know do the best you can. In other words, probably the biggest thing is, like I said, we've been a shop till you drop society for a long time. Um, if you can, and some people aren't, but and so they're a step ahead. But for the others, if you can kind of discipline yourself to say, maybe material goods and throwaway society is not the best way to prepare for what's coming. Because I can promise you, when we get to the collapse, things you threw out and thought, I don't need this anymore, you're going to wish you had. Then it's going to be a scarcity of things. I would
Yeah.
encourage people, and I'm not trying to scare people. It's still a decade off, I think. And so my point is that there are things you can do to prepare in the next decade to give yourself a fighting chance. But I would just encourage people to maybe read a little bit about the 2030s, 1930s. Read about the Great Depression, and I'm not saying we'll see it exactly like that, because it'll be different than that, but just understanding you can go from roaring 20s where everything looks great and party on, to a point where it's like, wow, in a short time we went from good to really bad.
Yeah, things can change quickly. And I really appreciate your time, David, just walking us through what you see, coming up in the short term, of course, with the melt up, your updated targets, the whole bust scenario, what the factors behind that, and then, a little harder to maybe accurately see what comes after that, but talking about, yeah, of course, what people can do to prepare, getting your financial house in order. And I know you're very active on Twitter at Dave H. Contrarian. You also put out a quarterly letter by subscription. Is that, do people just reach out to you directly for that, or?
Yeah, the best way for the letter, and I'm getting an awful lot of people on Twitter or on X, um, saying, "Can you sign me up for your letter?" Or, "I want to sign up for your letter." And I think for most of them that say that, they're thinking it's a freebie, that it's just put me on your list and send me your letter, or tell me how I can read your letter. It's by subscription. That means it's an annual subscription. There's a price to it. If people still are interested, knowing enough to pay for it, they can um, send a chat message to me. It used to be a direct message was what I used as the term for X's message system, but they changed it to chat in the last couple months, and it's an encrypted system now. It's got a lot of glitches to it, and I don't know whether they're working on them or not, because I see no changes. It's complicated my life a lot because I used it a lot to communicate on the subscription. And just as an example, I'll get a bunch of them, particularly lately. Um, and I'll reply to them, and I can't tell whether they can read my reply or not, because what I get is a message. It doesn't show, it used to show what I sent, just like any
Mm.
message you sent, in an email or whatever, you'd see what you sent. Now it's something like did not load. And so, but oftentimes they are seeing it, but I don't know whether they're seeing it. Sometimes they aren't, and most of the time they are. And then when they reply to me, I can't read their message. So, but I do when they reach out to me on chat, I send this, you know, extra this info, comes in a basically a paragraph of info, and within that is my email address. So once you get that, and if you're interested, you can email me and we can have a conversation, because people are still trying to do it through chat, and sometimes I'm not able to see what they're saying, and I'm not sure if they're seeing mine. It's a mess. I mean, that's all I can call it. Is
Yeah.
I know Musk has bigger things to do, but he better get somebody in there to fix it, because it's a mess.
Okay, well, there you have it. Reach out to David Hunter on X if you want his letter, or to just follow him. He's very active there most days as well. So, to keep up to date with you, David, I thank you so much for taking the time to chat with me again today. It's crazy to think that it's been about 5 years now that we've talked, about every 6 months. So, I really appreciate your time over the years, getting to watch and learn from you.
Sure, Logan, glad to do it, and great to know you, and hope you can get through the rest of the winter out there in Montana.